Today, the crunch is nearer now. Welcome to the Property Imperative Weekly of the 26th of May 2018. Hello, I'm Martin North from Digital Finance Analytics. Welcome to our latest summary of finance and property news to the 26th of May 2018, with a distinctively Australian flavour. I've had a number of interesting discussions with people who follow our analysis of the property market this past week. One in particular, which stood out, was from Melbourne, who told me that in February 2017 he decided to sell his home and got an indication that it would sell conservatively for $1.3 million. After a delay, he took it to auction in August 2017 and struggled to see $1.25 million. But that property is now worth $1.15 million, a $150,000 drop, which is an 11% fall. He also told me that back in 2017 he could get a mortgage of $980,000, but now, on the same financial basis, he can only access $670,000 today. And that, in a nutshell, is what's happening in the major markets, with people's mortgage borrowing power being curtailed, and as a result, home prices are falling, and they will fall further. We had a bevy of analysts revising down their forecasts for future home prices this week. Now, it's tricky to determine the extent of any fall ahead, and most predictions, of course, will be wrong. But the more significant factor in play is the change in the atmospherics around the housing sector. More are going negative. And when the largest lender in Australia signals they expect a fall, even a mild one, this is significant. Recently, Morgan Stanley said that it is predicting property prices could fall by around 8% in 2018, and lending will fall by more than a third. Morgan Stanley suggests that there will be not only further price weakness in the months ahead, but also the likelihood of renewed softening in building approvals. It says that these two factors will likely weigh on household consumption and building activity, seeing Australian economic growth decelerate rather than accelerate this year. And CBA has also gone negative on housing, now forecasting a mild correction. Gareth Aird, senior economist at CBA, says that Australian residential property prices have fallen over the past 6 months. Additional declines appear likely over the next 1.5 years due to a further tightening in lending standards, a continued lift in supply, potentially higher mortgage rates, and more rational price expectations from would-be buyers. But he says a hard landing, however, is unlikely, and it is not our central scenario. We discuss this analysis in more detail in our recent release, Another Bank Goes Negative on Housing, which is still available. And remember, CBA is the largest mortgage lender for owner-occupied loans. Until recently, they were bullish on prices, so this reversal is significant. And UBS, who called the top of the market earlier than most, says macro-prudential tightening phase 3 is a game changer that will materially further tighten credit ahead, with higher living expense assumptions and debt-to-income limits, cutting borrowing capacity 30 to 40%. Indeed, they say housing is already weakening more quickly than our bearish view, with home loans dropping by around 10% since August 2017, and that's before the full Royal Commission impact. We've shifted our base case, they say, towards our credit tightening scenario, where household loans fall around 20%, credit growth drops to flat, prices fall persistently, and the RBA holds for longer. This, coupled with record housing supply in coming years and a slump in foreign buyers, sees us downgrading our home price outlook to a fall of 5% plus over the next year, whereas previously they were forecasting 0 to -3. They conclude that housing activity will correct and prices will fall, still with downside risk. We still expect commencements activity and prices to have an ongoing downturn until at least 2019, with downside risk from a credit crunch scenario amid regulatory tightening and the Royal Commission. But they say housing should not crash without unexpected RBA rate hikes or higher unemployment. So that's okay then. CoreLogic added some colour to the question of home prices by assessing home price growth across each decile, which confirms that values have fallen fastest at the premium end of the market. The broad trend findings in the CoreLogic May decile report showed that values have fallen on an annual basis across the 10th decile, the premium end of the market, while all other valuation deciles enjoyed positive, albeit restrained, growth over the 12 months to April 2018. National dwelling values were 0.2% higher over the 12 months to April 2018, the slowest annual growth rate since values fell 0.3% over the 12 months to October 2012. Analysing deeper at a decile level, it's only the most expensive 10% of properties that recorded a fall in values over the year, down 4.3%, and all other sectors recorded annual growth greater than 0.2%. In Sydney, the most expensive decile has fallen 7.2% over the past year, while in Melbourne, the same decile fell just 2.4%. In contrast, the cheapest 10% of houses rose 1.5% in Sydney and 11.9% in Melbourne over the past year. This is thanks partially to first-time home buyer stamp duty concessions implemented by both state governments from 1 July 2017. But be warned, if Perth is any guide, the top of the market falls first, but other sectors soon follow. This is one reason why we continue to hold the view that prices will drop further than many analysts are predicting. The credit tightening is real, borrowing power is being reduced, and investors are voting with their feet. We continue to see investors planning to exit the market before prices fall further. And if you want further evidence, look no further than the latest auction clearance rates. CoreLogic says the combined capital city auction markets continued to soften throughout 2018, while volumes have remained relatively steady over each of the past 3 weeks. The weighted average clearance rate has continued to decline. In fact, last week, the combined capitals returned a final auction clearance rate at a record year-to-date low of 56.8%. The last time the clearance rates were tracking at similar levels was back in early 2013. With 2,100 homes taken to auction last week, almost half failed to sell. And over the same period last year, the clearance rate was much higher at 73.1% across a higher auction count. In Melbourne, the final clearance rate increased last week across a slightly lower volume, with 62% of 1,033 auctions reported as selling, up slightly from the previous week. Sydney's final auction clearance rate fell to 54% last week, the lowest recorded since 2017, with 672 homes taken to auction, which was lower than the prior week, when 787 auctions were held and a higher 57.5% cleared. And across the remaining auction markets, Adelaide was the only capital city to see a rise in clearance rates last week, with volumes also increasing across the city. And this trend is set to continue, with CoreLogic currently tracking 2,164 auctions, increasing slightly on last week's figure of 2,110, and Sydney is expected to see the most notable difference in volumes this week, increasing by around 50% on last week. Melbourne is set to host 1,064 auctions this week, remaining somewhat consistent with last week. And by the way, there are still doubts around the auction stats, as we discussed in Auction Results Under the Microscope. Across the smaller auction markets, Tasmania is the only other auction market to see a rise week-on-week volumes, with Adelaide and Perth down more than 30% on last week, while Brisbane and Canberra's volumes are down to a lesser degree. When compared with activity last year, both volumes and clearance rates were tracking considerably higher. So all the indicators are for more falls. And as the property market rotates and demand slackens, property developers with a stock of newly built or under construction dwellings, mostly high-rise apartments, are trying tactics from deep discounting, cash bribes, or 100% mortgages to persuade people to buy. Remember, there are around 200,000 units coming on stream over the next year or two, and demand is falling. So we were interested to see, and thanks to a tip-off from one of our community members, a WA initiative which was recently announced by Apartments WA, which is backed by the foundations of the BCG Group, Western Australia's largest residential builder and largest private company, they say. We will make your buying journey a seamless process, from finding you the right apartment, assisting with obtaining finance, right through to settlement and key handover. They've coined the preposit. In essence, a buyer gets to live in a property while saving for a deposit, and when that deposit is accumulated, they can complete a purchase. It's a way to get currently vacant apartments occupied by people who ultimately may buy. They call it the afterpay of the real estate industry. The weekly payments would cover the equivalent of rent and saving for a deposit, and finance is provided by Perth-based Harrisdale Proprietary Limited, trading as the loan company. They hold a financial services licence. Now, there are a few details on the Preposit site, and we have no idea of the financial arrangements below the surface. So we suspect any prospective buyer should ask some hard questions about the overall risks and real effective costs. Remember that they are not an authorised depository institution, so any money saved with them for a deposit could be at risk. I put in a call to the company, who said they will call back to discuss Preposit, but they never did. I've been following the latest rounds of the hearings at the Royal Commission in the banking, superannuation and financial services industry, which is exploring lending to small businesses. It's been quite dramatic, with stories of business owners with impossible dreams walking into commercial ventures which had a limited chance of success. The banks on the stand appear to have made procedural mistakes, and when things go wrong, often went in for the jugular to cover their losses. This includes relying on guarantees, even if it meant selling the guarantor's property, and the case studies included sad stories of people losing their homes. This included a disabled pensioner, blind and riddled with medical problems, her daughter, a budding small business operator, or an ambitious woman trying her hand at running a pie shop with the hope of retiring early. But the way the story is presented is only half the truth. Yes, the banks failed in their duties on occasions, but on the other hand, many businesses need finance if they are to start, and banks want to lend. But what is really going on? My theory is this: that there are small businesses who are not able to access the advice they need to make a balanced assessment as to the viability of their operation. By default, they assume that if the bank provides funding, then the business must be viable, but this is not necessarily so. The bank is only concerned with protecting their loan and ensuring that they can cover the risk of loss. This is not the same as considering the business in the round. We discussed this analysis in more detail in our recent release, The Problem with Small Business Lending. And remember that about 53% of the nation's 2.2 million small businesses need finance to continue trading. The Australian Financial Review reported on our recent research on the Bank of Mum and Dad funding business startups. More than 33,000 business owners are estimated to have seed financed or ongoing financial support from loans that are secured with their parents' home. Analysis of home ownership and borrowing numbers reveals the average cash injection is around $56,000, but loans typically range from a few $100s to more than $1 million. But while the number of parents providing direct cash support to their siblings' businesses is increasing, there has been a big fall in the number willing to put their houses on the line. And that's because of increased understanding that a lender could foreclose if there is a default, which means that parents' best intentions risk the threat of homelessness by prodigal sons or daughters. The number of parents guaranteeing a loan with their homes has fallen by 8% in the past year. And this is because of greater focus on financial advice and a better understanding of the risks involved with a guarantee. Plus, thanks to the strong rises in property, there is more equity in a property available. Next, we'll look at the latest from the US, where the adjustments to the Dodd-Frank Act, DFA, does that sound familiar, are expected to be signed into law next week. The changes ease the capital and regulatory requirements for smaller institutions and custody banks by raising the systemic thresholds to $250 billion from $50 billion for enhanced prudential standards, reduced stress testing requirements, and modifying applicability of proprietary trading rules, the Volcker Rule. The legislation reduces regulations for US small to medium-sized banks in particular, while only providing de minimis regulatory relief to the largest US banks. The change to the systemic thresholds reduced the number of banks subject to heightened regulatory oversight to 12, down from 38. And regulators still have discretion to apply the rules to banks between $100 and $250 billion in assets. Banks above $250 billion in assets would not get much benefit from the legislative change. Now, Fitch Ratings says that stress testing has provided discipline for banks, and it is an important risk governance practice that is considered in its rating analysis. So the elimination or meaningful reduction of stress testing would likely have negative ratings implications. And this is a time when debt is very high. Moody's says that a return to a 3% plus 10-year Treasury yield is making itself known to the housing industry. Markets have already priced in a loss of housing activity to the highest mortgage yields since 2011. They conclude that just as it is overly presumptuous to predict the nearness of a 4% 10-year Treasury yield, it is premature to declare an impending top for the benchmark Treasury yield. Thus far in 2018, they say, the 11% drop in the PHLX index of housing sector share prices differs drastically from the accompanying 3% rise across the market of US common stocks. And in addition, the CDS spreads for housing-related issuers show a median increase of 78 basis points for 2018 to date, which is greater than the overall market's increase of roughly 23 basis points. And finally, 2018 to date 1.97% return from high-yield bonds is worse than the minus 1.3% return from the US overall high-yield bond market. Despite the lowest unemployment rate since 2000, the sum of new and existing home sales has dropped by 0.7% year over year during January to April 2018. And all this shows the impact on the housing sector as rates rise. They say that the highest effective 30-year mortgage yield in 7 years has depressed applications for mortgage refinancings. For the week ended May 18, the MBA's effective 30-year mortgage yield reached 5.01% for its highest reading since April 2011. The effective 30-year mortgage yield over the last 4 weeks was 4.95%, which was up 63 basis points from a year earlier. March 2018's 7% yearly drop in the NAR's index of home affordability showed that the growth of after-tax income has not been rapid enough to overcome the combination of higher home prices and costlier mortgage yields. Next, according to the latest from the St. Louis Fed On the Economy blog, individuals who were in financial distress 5 years ago were twice as likely to be in financial distress today when compared with an average individual. They argued that financial distress is not only quite widespread, but it is also very persistent. They show that the share of households with past financial distress increased from approximately 6.6% in 1998 to 12.2% in 2016. And they conclude that households that have encountered an episode of financial distress in the past are 1.5 times more likely to delay payments today compared with average households. Why is all this US data relevant to us? Well, first, the debt levels in the US are significantly lower than here, as home prices relative to income are lower there. We have more households in financial difficulty here as a result. Second, the higher rates are likely to impact local funding costs here, which will put pressure on local banks' funding costs. And third, higher rates will further tighten credit availability. And as in the US, this is likely to impact the construction sector. So expect to see more unnatural acts to try and attract buyers into a falling market. To which I reply, caveat emptor, let the buyer beware. Finally, the latest data from S&P Global Ratings, using their mortgage performance index, the SPIN index, to March 2018, shows a rise in arrears. They increased to 1.18% in March from 1.16% in February, and there was a significant hike in 90-day plus defaults. Western Australia and Northern Territories continue their upward trends, both well above 2% and rising. Home loan delinquencies fell in New South Wales, Queensland, South Australia, and the ACT in March. And of note, mortgage arrears in South Australia appear to have turned a corner, they say. The state's March 2018 arrears of 1.35% are well down from their peak of 1.81 in January 2017. And this reflects, they say, a general improvement in economic conditions in South Australia, in line with national trends. Western Australia remained the state with the highest arrears, sitting in March at 2.37%. But S&P says that arrears more than 90 days past due made up now 60% of total arrears in March 2018, up from 34% a decade earlier. This shift partially reflects a change in the reporting of arrears for loans in hardship that came in response to regulatory guidelines, but they say even accounting for this, there's been a persistent rise in the 90-day plus arrears category. And I recall Wayne Byer's recent comment to the effect that at these low interest rates, defaults should be even lower. So the pressure on households is set to continue. The crunch is getting nearer. If you like what you've seen here today, please like the post and add a comment or a question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And if you've already subscribed, thank you. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.